Robschild, no investment advice. Welcome to the show where we view the financial markets using Benjamin Graham's investment philosophy, macro technicals, and a touch of crystal ball gazing. Today is Thursday, February 27th, 2025. We'll start today's episode actually talking about the velocity of M2 money stock. What this number represents right here on the FRED, it defines it right here. I don't know if it's too small to see, but it says the number of times $1 is spent to buy goods and services per unit of time. How fast is money being exchanged from one hand to another? And the insight that it gives is into whether consumers and businesses are saving or spending their money. And so when this is going down, obviously it means people are saving more money, and when it's going up, people are spending more money. Now, if the velocity of money is going up, you kind of, we usually think of that as like economy heating. Earnings can be higher, inflation can be higher, those kinds of things. And looking at today's chart, just on the very tail end of here, you can see that for quarter 4 2024, we ticked down from quarter 3 from 1.387 to 1.386. Now, Robschild, that is only 1,000th of a point lower, while this has moved much bigger movements in the past. But when you scroll out a little bit here, you can see that the M2 money stock velocity has not gone down. It hasn't gone down from one quarter to the next since quarter 1 of 2021 to quarter 2 of 2021. Since then, this has been climbing up and up and up and up and up. And today's report shows the money supply actually, the velocity of M2 money supply going down, suggesting that there's more saving going on and less spending. Now, scrolling out, this chart alone doesn't give a perfect indication as to when a recession is occurring, but you can see in the gray bars here, most of the time, velocity of money, well, pretty much every time, whether it's in the middle or during the whole thing, most of the time it's going down during a recession, and that just makes sense. People are trying to save more, they're trying to spend. It's a combination of spending less and trying to save more. I mean, some of the spending less, with the velocity slowing down, is simply because of people having less work, less money being made by people, unemployment going up, is part of the sad reality of how this works. But yeah, this recession going down. 1970 going up and then going down. And then, granted, in between these recessions, you've had it bumpy going up and down. But, 1980 went down. 1981 collapsing. The 1991 went down. .com bust went down. Great financial crisis dropped very significantly throughout that period. And ever since 2009, the velocity of M2 money supply, it's been falling off of a cliff, and we got to an all-time low in 2020 at 1.128. Since then, we've been climbing back up. I find it notable that we're ticking back down, and I'm kind of wondering how low can this go. For me, if this, if this goes down like lower and lower and lower and lower, that's deflation. That to me says we're headed into a major slowdown. That looks more like what happened in Japan for a while after their big stock market bubble burst. So we'll see how it all pans out. Anyway, next thing on the agenda, Nvidia earnings came out yesterday. I covered it in the after hours, and it was up a little bit. Apparently, the institutions wanted to trick people or something to buy into it, because it lost 8% today. I'm not sure in Nvidia's history if we've ever seen a red candle this large. I mean, look at this thing. Not only that, it opened on the day higher, and then just the bears just pushed it so hard down. This is an extremely large and powerful bearish candle. It suggests that Nvidia is likely going to head lower here. And then, SMH, the semiconductor ETF that holds Nvidia and all the other ones together, went down by 6%. Same kind of thing. It opened higher, and just look at that candle. Amazing. There is a Wall Street phrase that says follow the semis, and if this can act as a leading indicator for the economy, for markets, for everything. And so, I don't know. Let's see what Mr. Market does with this tomorrow. Companies that have an enormous amount of speculative value priced into the price of its stock have, are at extremely high risk. As soon as you realize that, a company's earnings can't grow enormously forever, extremely high PE ratios start to look just clownishly silly. And I think that might be part of what's going on. I don't really know. Mr. Market's rubbing his eyes, waking up a little bit to his reality. More than anything is the way I see it. Next, the initial jobless claims for last week came out markedly higher than the expected in the last. I've heard it being sort of a yellow flag above 250 and a red flag above 300 per week. And these numbers change a lot, like week to week. So anything could happen. But if this is the point where it's like week after week, like things are really falling apart faster and faster, yeah, it could be happening. It could be happening right now. These could be the first little signs. Last agenda item, Friday, PCE coming out tomorrow. Very, very, very important gauge for inflation, personal consumption expenditures. This is the Fed's guide to say, are we cutting and how much and how quickly? It's likely I'll need to do an update in my macro show soon, but for now, not any major changes. Last update to 1125. Watch it to hear me read through these very important items. And watch the portfolio update to 1125 to hear me read through and explain crystal ball readings and my portfolio. After previously finding support on this little blue line, Mr. Market wasn't sure if we were going to be able to go through it. Wow, we cracked through it hard today. We're increasing momentum to the downside is the way that I look at it. Some people are sort of saying, well, if PCE comes out, super high, that like it's saying inflation is higher than, people even think it is, that'll like continue the market to go down. I don't know how Mr. Market's going to react. I mean, my perspective is a little bit the opposite. The idea that like if PCE is like super low, would be problematic on the other side. It's just, screaming that the Fed is like clearly way behind cuts and that, come on, give me some candy, says Mr. Market. We need cuts like now, like tomorrow, emergency meetings. Let's get these going. I think they're coming. I think they're coming now. But that's just me and my crystal ball here. One thing adding to the bearish case of the S&P 500, the advanced decline line ticking down finally and showing a lower low that we've seen in a while. So yeah, we're building momentum to the downside. Mr. Market, it looks very bearish at the moment to me. I said in yesterday's show, we're probably at the point of the cycle where we're going to see the Fed funds futures price in more cuts sooner and sooner, and it's exactly playing out that way. It was just a week ago where we were pricing only one cut for all of 2025, and now we see three cuts. We see the first cut in July, second in August, and then third cut in December. And I don't doubt that it'll go even more, and we'll see. We're just at that point. We're at the point of the cycle where things we're going back down. That's what I think anyway. We'll see. I mean, let's see what the PCE data is tomorrow and how all the markets react to that. The last 2 or even 3 days, or it was really the last 2 days, it looks like the VIX may have, reached its top here, and then, but we got another big candle to the upside. So the VIX is rising, gaining strength, it seems. I'm not going to lie, I find it odd that credit spreads are getting tighter from yesterday to today, along with such a big market sell-off. Junk bond buyers and holders, they're apparently not worried yet. I'm really surprised about that, especially after today. I was thinking for sure credit spreads, with what's going on in markets, have to be widening. We tightened. I mean, not a lot, but the fact that it went from yesterday to today tighter is like, it's wow. I'm flabbergasted. It's probably happening off of something that I don't. I mean, obviously it's happening off of something I don't know about, because it doesn't make any sense. It would make sense if the stock market continues to the downside, for credit spreads to continue their path to widening further. I've been mentioning that since Tuesday of this week, gold's starting to look bearish, and this is today's candle, Thursday, and then this is like the UTC time, so after Thursday, just continuing lower. I mean, with momentum going down, it looks bearish. We'll probably get some buyers around the 27.89 level, but for now, gold is getting cheaper. And also Bitcoin dropping again. Today's candle so far right now, down another 5% at 80.3 thousand. I said yesterday this looks like really bearish, because we broke through this. We broke through the flat line. We broke through this line, and it falling. I've heard some chartists talking about it, an expectation to get to the 75,000 level before we see some kind of support, and then we may bounce back up from there, or continue lower. I don't know. I also wanted to share IWM. I don't bring this up often. This is the small cap index, just to show that, it's not just Nvidia and the semiconductor industry selling off. It's pretty much all risk assets and gold. But yeah, for now, Mr. Market, all in all, total, fully looking bearish. Never mind the junk credit spreads here, which let's see what happens tomorrow. Last chart of the day, KWEB. Again, this is like very undervalued stocks. I'm happy to be invested in something that looks cheap to me. I mean, who wouldn't want to own something that seems cheap, that like it will surely appreciate in price, when it's like clear that it's very suppressed, and comparing its price to its value, comparing, how much money these companies make compared to how much the companies themselves cost, based on their market cap, based on their stock price, based on how much money they make, the price earnings ratio. This is not a little thing. So there's just so many people that blow off PE ratios as like they just don't matter anymore, that they're meaningless. They are extremely important. They are the most important thing when it comes to valuing stocks. But I digress. KWEB, I just noticed very recently, we are in this now channel. This is a bull flag. So, we went up. We had a little flag, we went up, and now we have a flag here. The most likely scenario is actually for this to break out to the upside, but I don't know. What do I know? I'm just the guy with a crystal ball. And that's all from me and my crystal ball. Hope you enjoyed. Thank you for watching and supporting, and see you later. Robschild.